Congress and the White House are currently barreling towards a June 1st deadline to resolve a debate over the debt ceiling, with the full faith and credit of the United States on the line. The two sides are currently at a stalemate, with Republicans demanding sharp spending cuts in exchange for raising the debt ceiling, while Democrats want a clean bill that increases the ceiling with no concessions. But what exactly is at stake here? What is the debt ceiling, and why does it matter? Hey everyone, I'm Noah Zerbe. I'm a professor of global politics and political economy at Cal Poly Humboldt. Welcome to IR Explainer, where I explore the theories and concepts behind current events in international relations. Let's start with some background. The United States debt ceiling is a statutory limit on the amount of debt that the U.S. Treasury can issue to finance governmental operations. To be clear, the debt ceiling is not about authorizing new spending. Rather, it's a limit on how much national debt the Treasury Department may incur to pay for federal spending that's already been authorized by Congress. And this is a common misconception. Not raising the debt ceiling will not affect total U.S. debt. Instead, it affects the ability of the government to pay for spending that's already been authorized by Congress. In other words, the debt ceiling does not directly affect federal spending or the total national debt, but it does limit the ability of the government to borrow money to pay for spending that's been authorized. The national debt ceiling was first enacted in 1917, and it's been raised over 100 times since then. Indeed, the debt ceiling was raised 74 times between March 1962 and May 2011, including 18 times under President Ronald Reagan, 8 times under President Bill Clinton, 7 times under President George W. Bush, 5 times under President Barack Obama, and 3 times under President Donald Trump. Currently, the U.S. debt ceiling is set at $34.1 trillion, or about 120% of gross domestic product, a figure we officially reached on January 19, 2023. Since then, the Treasury Department has resorted to extraordinary measures to pay for federal spending. These extraordinary measures essentially give the Treasury Department or the government a little more time to sort out the debt ceiling standoff. Extraordinary measures are essentially accounting maneuvers that allow the Treasury Department to shift money around between government accounts to remain under the official borrowing cap. These measures include, for example, suspending certain payments on investment plans or savings plans for government workers, as well as health plans for retired postal workers. But these are temporary measures, and by law, the accounts must be made whole with interest when the debt ceiling is ultimately raised. However, the scope of extraordinary measures is necessarily limited, and while they can buy time, they can't bypass the crisis altogether. They've regularly been used in recent years and have delayed action required to address the debt limit by periods ranging from a few weeks to several months. But according to the Treasury, its ability to rely on such extraordinary measures is running out, and unless the debt ceiling is raised, the government will officially run out of money sometime around June 1st. So what happens if the U.S. fails to raise the debt ceiling and defaults on its debt? First, it's important to understand that the U.S. dollar is the world's reserve currency, meaning that it's the most widely held and traded currency in the world. As a result, the U.S. defaulting on its debt could have far-reaching consequences not just domestically within the U.S., but for the global economy as well. Domestically, reaching the debt ceiling would result in the shuttering of most governmental functions. Without congressional action to authorize payments, Social Security payments, salaries for federal civilian and military personnel, and other payments would not be made. Entitlement programs from Medicare and Medicaid to food stamps would be shut down, and most governmental services would be suspended. More broadly, there would likely be a loss of confidence in the U.S. dollar, which could lead to a decline in its value relative to other currencies. This would make imports more expensive for U.S. consumers, fueling inflation and reducing the purchasing power of U.S. businesses and households. This would likely be exacerbated by a downgrading of U.S. debt by credit rating agencies, further increasing borrowing costs for the U.S. government, as investors would demand higher interest rates to compensate for the increased risk of default. This would effectively increase the size of the national debt, as borrowing to finance existing debt would become more expensive. Global financial markets would likely also be disrupted. U.S. Treasury bonds are widely held by central banks, sovereign wealth funds, and other institutional investors around the world. If the U.S. defaults on its debt, these investors could suffer significant losses, which could trigger a wider sell-off of assets and a decline in investor confidence. And finally, a U.S. debt default would have geopolitical implications. A default would undermine the position of the United States and its credibility as a reliable trading partner in international economic relations and weaken the influence of the United States in global governance institutions like the International Monetary Fund and the World Bank. And in the worst case, hitting the debt ceiling could lead to a liquidity crunch or a credit freeze, likely triggering a global recession. A liquidity crunch occurs when there's a shortage of funds in the market, making it difficult for banks and other financial institutions to lend money. A credit freeze, on the other hand, happens when lenders become unwilling to lend money to borrowers, causing a shortage of funds. Either could be triggered when the U.S. government is unable to borrow more money to repay its obligations, rendering it unable to pay its bills and causing lenders to become hesitant to lend further money to the government. This would create a domino effect, with businesses and consumers also becoming unlikely to borrow. Ultimately, this could trigger a global recession as businesses are unable to operate and consumers are unable to spend, leading to a slowdown in the global economy. So, what are the prospects for raising the debt ceiling and avoiding the crisis? This situation is complicated by the partisan politics and polarization in Washington. The debt ceiling has become a bit of a political football, with some lawmakers using it as a bargaining chip to extract concessions from the other party or to advance their own policy goals. Moreover, the current political climate is characterized by a lack of trust and cooperation between the two major political parties. Republicans are insisting on spending cuts and other fiscal reforms before agreeing to raise the debt ceiling, while Democrats are advocating for a so-called clean increase that raises the debt ceiling without any additional provisions or conditions attached. These debates reflect larger ideological differences about the role of government in the economy and society, as well as the appropriate balance between spending and taxation. They also highlight the challenges of governing in a deeply divided and polarized society where compromise and consensus building are increasingly difficult to achieve. Congressional Republicans assert that spending cuts are necessary to restore fiscal discipline and trim runaway government spending. Democrats have countered that Republicans made no such demands when they controlled the White House, increasing or bypassing the debt ceiling without any conditions on 3 separate occasions under President Trump's rule. As the negotiations have dragged on, some Democrats are calling for measures to bypass the debt ceiling altogether, and there are several ways that this might happen. First, President Biden could simply choose to ignore the debt ceiling and order the Treasury Department to continue to borrow to pay for government spending normally. In doing so, he'd likely reference the 14th Amendment of the U.S. Constitution. Ratified in 1868 as one of the 3 Civil War amendments, the 14th Amendment is most well known for establishing birthright citizenship and guaranteeing due process and equal protection under the law. But the 14th Amendment also includes a provision in Section 4 that provides that the validity of the public debt of the United States, as authorized by law, shall not be questioned. Some scholars assert that President Biden could evoke the 14th Amendment to assert that the debt ceiling itself is unconstitutional, effectively bypassing the law and forcing Republicans to take up what could be an unpopular argument in the courts. Increasing the debt ceiling under the 14th Amendment could be seen as a quick and decisive solution to the debt crisis, but it comes with risks. Firstly, it would be a highly controversial move that could lead to political backlash and legal challenges, potentially leading to a constitutional crisis. Second, it could erode public confidence in the U.S. government, particularly in the eyes of global investors, further destabilizing global financial markets. And finally, it could set a dangerous precedent for future presidents to ignore congressional action and act on a unilateral basis in fiscal matters, undermining principles of checks and balances central to the U.S. government. Alternatively, some economists have argued that the U.S. Treasury Department could issue a $1 trillion platinum coin and deposit it with the Federal Reserve to pay for spending without issuing new debt. Under Section 31 U.S.C. 5112 of the U.S. Code, the Treasury Department is authorized to mint and issue platinum bullion coins in any denomination the Secretary of the Treasury may choose. Ironically, this law was originally passed in 1996 by a Republican Congress over objections by the Democratic White House and Treasury. Minting a platinum coin to pay for spending without issuing new debt has the advantage of being a legal loophole that would allow the U.S. to avoid technical default without violating the debt ceiling law. However, it could have negative consequences. Firstly, it could undermine trust in the U.S. dollar as a global reserve currency, as investors may see it as a desperate move. Secondly, it could also fuel inflation by injecting large amounts of cash into the economy, further eroding the purchasing power of the US dollar. And third, it could set, again, a dangerous precedent for future governments to circumvent the debt ceiling by exploiting legal loopholes without addressing underlying fiscal issues. So far, both the Treasury and the Federal Reserve have rejected the idea of the platinum coin, fearing that such a move could undermine trust in the US dollar. But it would avoid the debt crisis. A third option that's been floated by some economists that might bypass the debt ceiling crisis would be to issue what are called super premium bonds. The concept here is that the debt ceiling applies only to the face value of Treasury securities and not onto the interest rates they carry. As a result, if the Treasury Department were to issue bonds with very high interest rates but with low face values, this could raise more money while taking on less debt by face value. Currently, if the Treasury issues a one-year security, you might pay $100 up front for the instrument and can redeem it, say, in a year for $104.05. The original $100 that you lent the government plus $4.50 in interest. If the Treasury Department were instead, say, to offer a $100 bond that paid 109% interest, it could be redeemed for $209 at the end of the lending period. In theory, people might be able to pay as much as $200 for such a bond, even though it only has a face value of $100. This would mean that the government would get $200 in cash while only incurring $100 in debt, because the debt limit statute only considers the principal amount of the debt, not the interest paid. Issuing super premium bonds could allow the U.S. government to raise more money while taking on less debt at face value. This could be an attractive option for investors seeking higher interest rate returns in a low interest rate environment. However, it could also have negative consequences. First, we're not currently in a low interest rate environment. Second, such super premium bonds could lead to a spike in borrowing costs for the U.S. government in the longer term, as investors may demand higher interest rates to compensate for the increased risk of default. Third, it could set a dangerous precedent for future governments to issue complex financial instruments to avoid the debt ceiling without again addressing the underlying fiscal issues. And finally, it could be seen as a short-term fix that fails to address the structural issues driving the debt crisis, such as the growing national debt and political polarization. All of these are obviously imperfect workarounds, and the only real long-term sustainable solution to the debt crisis that doesn't endanger the U.S. economy or the global economy is to find a way to increase the debt ceiling. But that's, at least right now, maybe the hardest path forward. The possible default on the U.S. debt if the U.S. government fails to raise the debt ceiling is a complex and multifaceted issue with significant implications for the global economy. It highlights the challenges of managing public debt in a context of political polarization and ideological division. As always, we'll keep an eye on this and other global issues and provide you with updates and analysis as we can, but that's it for now. Thanks for watching, everyone. Please leave any questions you have on this topic in the comment section below, and if you have any suggestions for future explainer topics, I'd welcome those as well. Thanks for watching, everyone. Have a good day. Bye.